now.com.au.
Welcome back to Money Exchange. Let's take a look at one of this week's big currency movers. And there are a number of them this week, so I suggest you quickly grab a pen and paper because the content that I'm about to share with you is the professional view of some big banks in Europe and the US, and my contacts are generally on the money. The first currency I want to touch on is the US dollar, the granddaddy of all economic data releases. The official US unemployment report is released at 10:30 p.m. Sydney time this evening, and the market is expecting around 200,000 jobs to have been created. Traders are anticipating the unemployment rate to remain steady at 5.1%, but if the jobs data shows a reading of more than 200,000, I would expect hedge funds and large speculators will very quickly increase their bets. The US Fed will raise the official cash rate between now and Christmas, and this will highly likely send the US dollar higher and emerging market currencies along with the Aussie and Kiwi dollars lower. Janet Yellen said last Friday that raising the official rate in the coming months was likely appropriate, and as jobs has been her big mantra since becoming the US Fed chair, the market will closely watch the unemployment report. The US dollar should continue to be supported so long as the state of the US economy remains healthy. And once inflation starts to pick up in the US, that's when we're really likely to see traders begin piling into US dollars and US treasuries. And as a trader, I want to be a buyer of US dollars in the coming 6 months. US consumer confidence data released on Tuesday this week showed a significant jump in the level of confidence in the US economy, with a reading well above economists' expectation. The index reading rose to 103, which was 5 points above the expected reading of 98. That's the highest consumer confidence reading since the GFC in 2008, and in my view goes to show consumers are ready for an interest rate increase. Bring it on, please, Miss Yellen. Now, moving on to the Aussie dollar. The expectation is China will continue to slow, and this week's economic data once again failed to impress. Low commodity prices are likely to continue, with oil prices also to remain under pressure. Any country that has a large export exposure to China is likely going to suffer economically, and its currency is likely to come under selling pressure. The Aussie and Kiwi dollars, for mine, look vulnerable, and the expectations of further interest rate cuts are likely in both countries in the coming 6 months. Remember, it's not about one trader or one economist's views. It's going to be an expectation of collective views of large hedge funds and large speculators, and I can confidently tell you now they expect both currencies to decline in value in the coming 12 months. There's no question that Chinese economy is slowing and commodity demand is falling. And in the second largest economy in the world, it's trying to figure out ways to continue to grow at its promised rate of 7%. I think with global growth and emerging market economies struggling, that's going to be near impossible. Monday's data showed that in China's industrial profits shrank 8.8% in the month of August, so there is increased speculation the PBOC is going to try and do something in the coming months to ensure the economy reaches its growth target. A stimulus from the People's Bank of China will likely have a short-term positive impact on the Aussie and Kiwi dollars, but I think the smart money will look beyond any short-term stimulus and continue to price in a weaker China. And even potentially recessions in Australia and New Zealand. I'm not saying we're going to have one, but we haven't had a recession for 24 years, and I think there's an increased chance we could see one in the coming 18 months, which would highly likely send the Aussie dollar even lower again. Now, we've already been talking about the potential for a weaker euro on tonight's show, but what I didn't tell you is the price target of one of the world's biggest banks has for the euro. I read a statement Barclays in London issued this week saying their price expectation for the euro versus the US dollar was 1.03 by the end of this year. A bank like Barclays doesn't issue such a statement without a valid reason. The reason for their low price target on the euro versus the US dollar? Well, more stimulus from the European Central Bank before Christmas. Exactly what we've been talking about on this program for the past month. The same bank has an end of 16 price target of 95 for the euro versus the US dollar. It's little wonder the market's getting bearish on the euro. The official unemployment rate across Europe rose back to 11% in the latest August jobs figures were released. Spain's unemployment, 22%. Germany, they're at 6.4, which is 1.3 higher than the US. So Europe is certainly still struggling. Now it's time for our currency quiz question of the week. But before I give you this week's question, I'd like to congratulate Grace on being the first viewer from last week's show to correctly answer 19 as being the number of countries that use the euro currency. Well done, Grace. Okay, so let's get to this week's question for 500 big ones. Here it is. In what year did Australia change from a $1 note to a $1 coin? If you think you know the answer, jump onto moneyexchangetv.com and type in the correct year. And if you're the first person to answer, you'll win $500 cash. That's moneyexchangetv.com. Unfortunately, that's all we have time for tonight. I'll look forward to your company again next week when I share with you everything you need to know about global currency markets. See you then.